Welcome to Rural Classroom Live. I'm Albert Liu, and we are the online community for natural resource investors. Today, I'm joined, as always, by Rick Rule. Rick, how are you today?
Very well, Albert. Thank you. How are you?
I'm great, Rick. Lots going on. I'm sure you have a lot of things you want to talk about, and I'm sure our viewers have a lot of questions for you. So why don't we just get straight to it, Rick? What's on your mind these days?
So much going on. I could use the whole set with the beginning comments, which I won't do. A couple things have been on my mind today. Watching the news around the unfolding funding crisis in some U.S. regional banks reminds me really how precarious some aspects of private finance in the country are. There seems to be two predominant themes. The Zion Bank theme would seem to be a series of imprudent loans, lending to businesses they didn't understand. This makes absolute sense. We've gone a fairly long time without a credit crisis, and the consequence of that is that bankers, like everybody else, begins to feel smarter than they are, lending outside their core competence. The other problem has to do with, ironically, the alleged shutdown of the federal government and the fact that a lot of regional banks who rely on overnight funds from the Fed are beginning to run into funding problems. This too speaks to another sin in banking, which is to say, lending long and borrowing short, funding long-term obligations with overnight deposits or repos or other short-term instruments. Banking is in and of itself a very, very, very good business if you are a banker like Ohio State used to play football, which is to say, if you focus on blocking and tackling. I say this not just as a founding shareholder and promoter of Battle Bank, but rather as a commenter on the financial services market and the broader financial market in the United States. The increasing reliance on gimmickry to generate earnings and the increasing willingness to take on too much risk and take on too much debt because by and large, the period 1982 to 2025, with some notable exceptions like 2008, has been fairly benign. But today's news around the regional banks tells us, I think, that the structure of our economy is and not just the public economy, not just the public economy, not just the government economy, but the private economy too, is somewhat more fragile than we believe. And not all of the fault, I'm sad to say, belongs with federal or state governments. We see from time to time real examples of corporate lunacy. Lending long and borrowing short is probably as spectacular an example as you could. It brought down Silicon Valley Bank. It brought down the U.S. savings and loan business. It was not good to First Republic Bank. I mean, these are avoidable mistakes. And they're mistakes that investors, both in the broad market, need to pay attention to because they roil the broad market. And they're certainly mistakes that anybody who invests in banking stocks or regional banking stocks should bear in mind. There needs to be a very rigid risk culture in a bank, and there needs to be a very, very rigid duration risk culture in banks. The temptation for banks is to become over leveraged, to chase yield at the expense of either credit or knowledge, which is to say, lending against businesses you don't understand, and to go for funding where the funding is easiest in now deposits or in Fed deposits. And both from the point of view of the economy and also from the point of view of banks, we need to, as individuals, address that. Albert, there's been a lot of social media hate about my discussion of selling 25% of my speculative positions. I'm now largely through that selling campaign. I've sold about 25% of my speculative pre-revenue juniors. I did it for a few reasons. Mostly because I could recoup all the capital I've expended in the sector in the last 5 years in one fell swoop. I could give up 25% of my upside via sales and eliminate my downside. The second thing is that the climate for the juniors in the very near term feels too frothy. October has traditionally been one of the best months of the year to be, it's been one of the best performing months in the year among the juniors. And I felt that October would have a lot of volume and I wanted to take some. That has been, for me, the right decision. When I look at the broad market around the juniors, what I see is a fair number of companies with no net present value, companies selling at huge premiums to what I think they're worth, raising 15 or $20 million with apparent ease. Make no mistake, when companies are doing financings, they are telling you that they believe that your money is worth more than their stock. That's why they're making the trade. When other companies, the Altius Minerals of the world, the EMXs of the world, are buying in stock with their cash, they're telling you something very different. And I prefer with the latter or telling me to the former. And I also engaged in the sales for a couple more reasons. The first was in a couple instances, I made mistakes where the mistakes were up 20 or 30%. Pretty easily when you're in a market like that. I mean, you should sell mistakes irrespective of whether they're up or down. But a market that's forgiving enough that your mistakes are up 30% is certainly a market that warrants some selling. Further, in a couple of the names that I sold, I owned 5% of the outstanding, which means I probably own 10 or 15% of the float. The time that you take liquidity in those positions simply is when you can. The fact that I've earned so much hate in the social media chatter tells me almost certainly that I did the right thing. As you know, I love hate. And so I think that was the right thing to do. Now, whether other people should do it or not is a very different question. Many people didn't get into these stocks as early as I did and didn't have the ability to sell off a fraction of their positions to take care of the downside. But I felt it was important at the Rule Classroom in particular, where people pay attention to what I say, that people know something about what I do in addition to what I say. So, Albert, public notice.
Yeah, Rick, and you're not getting a lot of hate inside the Rule Classroom, although people are definitely talking about your actions. I had Brian London on the stream yesterday. It was actually a very active day in the classroom. I had Brian London on, and he said a couple things. One thing he said was, well, Rick is one of those guys who could probably get out now and be smart enough to buy in sometime later at a lower price. In general, Rick, okay, maybe that's not what you're intending to do, but in general, what do you think about that outlook?
Well, certainly if the market gave me the opportunity, I would do that. But what I decided to do was, although I think the market's going towards alpha, I decided to change alpha for beta. I put about half the money from my sales into gold itself, Franco, uh, Wheaton, and Agnico. I actually think the market's going the other direction. I think the liquidity is going from the best of the best down to the smaller names. But I decided for my own purposes that while I thought that the gold market had a lot of beta left, I didn't want to take the alpha risk. So I took the money off the table. Brian gives me more credit for being a trader than probably he should. If we see a broad sell off in the juniors, I will definitely be back there. I will be back there if I see the financing window snap shut. There's lots and lots and lots of money going into these companies, and they're going into private placements, restricted stock at no discount with no warrants. In the near term, this market seems to me irrational. I need to say, some people are doing some very, very, very good work. There are some companies that, in a reasonable set of circumstances, I'd like to buy more of, but we're not in a reasonable circumstance market. This isn't the market call, by the way. I've told anybody who cares that I think that the purchasing power of the US dollar declines by 75% over 10 years. The consequence of that is that I think the nominal price of gold mirrors the decline in the purchasing power of the US dollar. Done, dusted. I just think that personally, for one small subsect of that market, the idea that I trade alpha for beta when everybody else is making the opposite trade makes perfect sense for me.
He also asked which of our fully paid issuing sponsors stock have you been selling?
Well, given that we have no fully paid sponsors, all of them, unlike Brian, we haven't figured out the revenue model at the Real Classroom yet.
Okay, be ready for that. That question's coming in New Orleans in a
I
couple
look
weeks.
forward to it. I look forward to it.
All right, Rick. The first part of your comments, that was a topic I was actually going to ask you about, because while I'm not really allowed or have never had any success asking you about Oracle or AI or NVIDIA, can certainly ask you about banking questions. And the banking sector, financial sector, is taking a hit today.
Yeah.
And the reasons that you outlined are, well, they're making me feel kind of old, actually, because it wasn't that long ago that we had a giant collapse. And the reason was very much the reasons that you laid
The
out.
same.
Is 10 or 15 years basically the amount of time the sector needs to forget what happened?
Probably needs less than that. I think every time they get away with it, they get bolder. Albert, you will remember, some of our listeners won't, but you'll remember 2008. You had a bunch of morons that conspired to lose a couple $1 trillion. And what they did was, first of all, they convinced Congress to bail them out when they should have been allowed to go broke. And then they convinced the shareholders to give them retention bonuses. When the people who engineered a $2 trillion loss got paid 20 or $30 billion in retention bonus, I knew that any chance of real reform was over, that I had to play the game around the edges. The time spread risk, which is borrowing short to lend long, is what brought down many banks during the Great Depression. It blew the US savings and loan business. It blew Silicon Valley Bank. It blew First Republic Bank. You don't do that. Yes, there is forwardation in interest rates. There's a time premium built in. But if you have an 8 or 10-year duration, particularly a fixed rate duration, where you're funding it with overnight funds at floating rates, if the interest rate goes up, the capitalized value of your yield falls. Your ability to sell it in the aftermarket at par falls at the same time that your cost of funds goes up. This is really, truly ugly in a business where commonly you're using 11 to 1 or 12 to 1 margin. So that a 3% decline in the value of your collateral wipes out your equity. The other problem is also as old as banking. It is really pretty easy to lend money. People are willing to take it from you. Surprise, surprise. Getting it back can be somewhat more tricky. And the consequence of that is that you have to loan money to people you know, or to people who are known to people who you know, in businesses that you understand. And from, I mean, in most people's experience, this is a fairly tight circle of competence. Buffett says, stay within your, draw a tight line around your circle of competence and stay within it. Battle Bank is an example. And, of all things in the cosmos revolve around Battle Bank for me right now. I understand a lot about gold, silver, and platinum and palladium. So we'll be lending against bullion. We'll do that. I know a reasonable bit about mining and oil and gas. And as the bank attains sufficient size and scope to take on corporate risks, we'll lend in that regard. We stay within our circle of competence. Many of these banks have been lending to businesses that they don't know enough about. And many banks also, as a consequence of many years of relatively benign credit conditions, particularly in the non-investment grade markets where most of these banks operate, have been taking too much credit risk for not enough yield. You know, if somebody can't pay you back at the prime rate, they probably can't pay you back at prime plus 3. The idea that you obviate the risk by raising the rate is not really good arithmetic, but people do it again and again and again. Remember that the Fed considers a well-capitalized bank to be a bank that has equity at 7% of total assets. That implies 12 to 1 leverage. There are things that you can do at 1 to 1 leverage, risks that you can take at 1 to 1 leverage that you cannot take at 12 to 1 leverage. You make a mistake there. Well, put a different way. One bad loan easily wipes out the margin for 20 or 30 good loans. So, and you know, what we're seeing today is just another example of the fact that a lot of people in business today, I think, just aren't using good common sense.
Rick, do you have any idea what's going on in auto finance? Because that's come up on some of the headlines, and I always thought that that would be something like later in the credit cycle that people would default on other payments first before the car. What do you have any insights to share on that?
I don't know enough to comment, except that consumer lending is not something that's ever interested me. That's a business where scale matters because your willingness to take loss is really a function of the rate you can charge. I'm not really interested in being a 22 or 23% lender, you know, a subprime auto lender or a revolving credit lender. I don't like the idea of lending money to people who are living beyond their means. That's not the kind of person that I want to lend money to. And the type of people that would seem to be experiencing the credit difficulties around auto loans are people that, in a reasonable set of circumstances, would have had trouble buying a car as expensive as the car they bought. Um, I see in some banks uh, credit card charge-offs now approaching 6% of assets under management and portfolio. That's a pretty ugly number in a business where you're running 12 to 1 leverage. Think that through. Now, thus far in the credit card business, uh, because they're charging somewhere between 20 and 30%, and their cost of funds is likely mostly the deposit interest rate. So let's say you're borrowing the money from your customers to the Fed at 4%, and you're putting the money out at 25%. If you don't have too many defaults, you do okay. But remember that defaults are hits to principal, not just to interest. So over time, that reliance on the trade-off between spread and charge-off, if it's allowed to get out of hand, can really have meaningful consequences in a business that's leveraged 12 to 1.
Right. Okay. Before we get to the questions, I just want to mention one of the things we did yesterday, Rick, is we had our friends from Meteoric on a live stream.
Oh, good.
Tunks, Nomi Prinz,
Good.
Andy Thompson joined us, and we did almost 2-hour deep dive into the rare earths question, starting with global macro, going on to geology, and then finally sort of commercial aspects. So if that is something that you're curious in or interested, go to ruleclassroom.com. We have a new section called Intro to Rare Earths. The first installment was the interview, Rick, that you did with David Wargo.
Great segment.
Yeah, excellent foundational knowledge. And we've just followed that up with this almost 2-hour stream with Dr. Tunks and Nomi Prinz. He goes into the geology of it. He talks about their particular deposit, but he gave us a very interesting graphical illustration of what's going on there, the dynamics with the clay, why that makes it easier and more cost effective to mine. I found it very enlightening. At one point, he was telling us about the team, and Dr. Tunks made a point of telling us he had something like 3 or 4 PhDs on the team. And I tried very hard and succeeded at not making a long-term capital management joke out of it. But no, it's good. And these are humble PhDs. So I'm all over that. They got their heads wrapped around the problem, Rick. Just your thoughts. I know you didn't see it, but I'm sure you'll watch it later. Your thoughts on what Andrew Tunks and team are doing down in Brazil.
Well, I've got a lot of time for him. First of all, I remember him all the way back to the Paladin days. And anybody who's part of a story that gives you a potential 1,000-to-1 return is somebody who you remember in good light for a long time. What they did there, really recognizing the significance of the Japanese work, and overcoming the sense that this was too good to be true, saying, well, let's go find out. It doesn't have to be too good to be true. I mean, the recognition of the opportunity set when nobody cared about rare earths was a pretty spectacular circumstance. And then the work that they've done since, they've had to overcome a lot of challenges. And I'm not suggesting, by the way, that they have overcome all of the challenges, but they've had to overcome a lot of challenges. This is a complex ore body in the micro sense. Yes, it's a big ore body. Yes, if you look at the entire ore body, you can make the case that it's a homogeneous ore body. But there are, different different strata of the clay that will have different processing characteristics. They've done a really superb job, I think, over time. They have also dealt with a variety of community issues, thus far, extremely successfully. The idea that NOMI is there to help them navigate the travails of Washington, although Dave Wargo can help with that too, I think is useful. As a taxpayer, I don't like the idea that our government is picking winners and losers and helping people out. On the other hand, if they're going to help somebody, I hope I'm long whoever they help.
Yeah, it was a great session.
Important. What's really important is that there's a community on the web that takes the time to do a 2-hour-long in-depth sequence on Meteoric, and there's an audience whose technique is not, quote, got a hunch, bet a bunch. That's lovely.
Rick, when you watch it, you'll be very proud. One of our students asked Andrew Tunks, what is your specific experience in Brazil, and particularly in rare earths? And he explained that while he was originally a gold guy, that he had gone back to school for this, maybe quite literally, hit the books again and boned up on it. And that's how he was able to recognize what this was, is he actually did some, foundational study here. So anyway, that was a good question. We had many good questions. So please, if you're interested in this, highly recommend. I would watch David Wargo's interview with Rick first, and then watch this almost 2-hour long webinar. It was great stuff.
I would also remind people that the next issue of the Rules newsletter with Paul Harris will be on critical minerals and rare earths.
Excellent.
That should be in people's hands, 10 days, 2 weeks. So
excellent. Good. So that's available in the Rule Classroom. You can also go to ruleinvestmentmedia.com, sign up to get on the email list for that. So let's try to get to some of these questions, Rick. They're piling up here. From Raul, what is Rick's opinion on Northern Dynasty?
I don't own Northern Dynasty. I love the deposit, but the company has done a really bad job overcoming the political and sociological challenges of that deposit. There is considerable Aboriginal disenchantment with the deposit. I would note that the Aboriginal group numbers 6,500 people. The opposition has spent about $400,000 in community relations, and First Dynasty has spent $72 million in legal. I suspect that there were better uses of that $72 million among the 6,500 people who are part of the First Nations that oppose that. From a technical sense, there is zero doubt in my mind that Northern Dynasty, were it developed, would obliterate 6 to 9 line kilometers of salmon spawning stream. There's no doubt about that. It occurs to me that in the district or elsewhere in Alaska, there are probably 2,000 line kilometers of stream in the Yukon drainage that have been damaged by mining. And if the company decided, as an example, that they would rehabilitate 10 or 20 line kilometers for every line kilometer that they devastated, I think they could answer that question. The chance that this mine has any material impact on the Copper River salmon run, I think, is nil. There would be real environmental consequences of running a road into the mine. It would, among other things, allow hunters, both Aboriginal and Native, easy access to an area that they don't have easy access to. And most people shoot caribou and moose where it's easy to get them out. So that would be a real problem that probably needs to be addressed. Suffice it to say, I don't own Northern Dynasty because I don't like the way that they've managed the environmental, sociological challenges, and those challenges are real. I love the deposit.
Okay, great. Here's an interesting question. So apparently our friend Steve Potteruk was in an interview and said that speculating in juniors isn't for those without geological knowledge. Echoing Jonathan Goodman's view that even Buffett or Lynch couldn't tell a good PFS from a bad one. That's a good insight from the last boot camp we had.
Those are different statements, of course.
Well, that's true.
Analyzing a PFS means having the ability to distill already distilled geological and financial advice and looking at assumptions. Some of what Steve says is true. Some of it is what you would expect a stockbroker who was a geologist to say. In other words, you can't get this done without me. You can. You have to ask questions at the real classroom among people who are geologists, or you have to subscribe to a newsletter like Joe Mazumdar's. There are lots of ways of getting geological expertise. Remember that I'm not a geologist. I have a minor in geology, but no degree. It bears noting. But I've been writing checks to geologists for 50 years.
Right.
I would argue that whether you pay commission or subscribe to a newsletter or spend time, that intelligent speculators without profound geological knowledge can do just fine in exploration. I would also point out that understanding geology and understanding a PEA or a PFS or a BFS are very, very, very different circumstances. One needs to be, how would you say, cautious, and one needs to do the work. One needs to be thoughtful. But checking out the assumptions in a PFS and asking oneself whether the information contained in the text is supportive of the summary statement is something that people without a large degree of technical skill can do.
Right. I mean, you're not making the argument, but if you were going to make Steve's argument, you would also have to argue why investing in mining stocks is different than investing in a pharmaceutical company. People who don't know about.
People ask me why I don't invest in NVIDIA, and I say that without Albert's help, I couldn't pronounce it. I actually think that trying to understand the impact of technology that hasn't been really, truly invented yet on a market that doesn't exist is more difficult than interpreting drill holes. I think technology investing is probably more difficult than doing exploration speculation. The data exists with technology that's known. You're talking about a market that exists today. I think it's simpler, frankly, than technology investing.
That's
Lots of people are comfortable with technology investing because it's worked for 40 years, not because they know anything about it.
Yeah. But you're talking two different things. Now you're talking future versus present markets, right? Future markets versus existing
And,
markets.
people are suggesting, I guess, that NVIDIA's product pipeline, with what they project will happen in terms of demand for that product with artificial intelligence, they suggest that they have the sophistication to understand NVIDIA's project development pipeline, or that they know something about what AI demand will do for those instruments. And I would suspect in most people's case, that isn't true.
Right.
You
Okay.
maybe, that's different.
I mean, I don't think the financiers of AI even know at this point. They seem to be waffling on what their commitment is going to be. So I'd be very wary of that. Let's see. Okay. Rick, what do you think of Meteoric's recent price increase?
I'm actually a little sad about it.
You want to buy more?
Yeah, I was hoping to buy some more. And I guess other people had the same idea. I need to remember to keep my mouth shut when I'm buying stuff. Um, this is not a lead pipe cinch. This is a very, very, very big deposit. It's becoming increasingly well understood. The infrastructure is not great, but it's not bad. But what keeps coming home to me is the fact that this is really big and really profound. And in the context of undeveloped but discovered rare earth deposits in the world, this is really, really, really important. I buy it because for me, the juxtaposition of risk to reward goes like this. If I'm wrong, I lose half my money in this investment. Not an outcome that I'd be thrilled with, but certainly one that I've achieved in the past. If I'm right, I got a 10 bagger or a 12 bagger or a 15 bagger. And the juxtaposition of a 10 bagger against a 50% loss, if the probabilities aren't really, really, really skewed, is attractive to me. I look at the whole range of potential tier 1 10 baggers, the Sovereigns, the Meteorics, the Centaurus in my portfolio. The idea that you could own 5 or 10 disaggregated bets where there was at least a possibility, a good possibility as opposed to a probability, that you make a 10 for 1 as opposed to losing 50%. It's very, very good math. Let's say that you invested equal dollar amounts in 10 of these things, just as a thought experiment. And let's say that you lost on half of them. So you lose 50% on 50% of your names. You're down, what's that make? 25%, something like that. But let's suppose 2 of them hit. So on 2 of your speculations, you're up 1,000% on each. The arithmetic juxtaposing what you won on your winners versus what you lost on your losers is extremely attractive. And I've been lucky enough in the course of my life to have had that work for me a lot, really. And I like it to happen a couple more times.
Right. Okay. Let's see. Adam wants to know if you are still a shareholder of Power Metal Resources.
I am. What Power Metals has done for 5 years is what I used to do privately, which is to say, build shells and help people capitalize early stage exploration ventures, getting in the ground floor by starting the ground floor. Their new idea, which is some sort of crypto-enabled funding mechanism for juniors, which the market seems to like, I'm a lot more skeptical about. But yes, in answer to the question, I still own it.
Okay. Haven't had one of these in a while. It's a uranium question. Kyle, do you have any preferred U.S. uranium names, Rick? Who do you like?
I mean, my favorite name is quasi-US. It's Cameco, the biggest and the best. It's really a Canadian name, but it's New York Stock Exchange listed, and most of the trading volume takes place in the United States. I own Energy Fuels, which is both a uranium and a rare earth processing name. I own some UEC, although I own precisely half as much as I used to. My stake in Uranium Royalty is undiminished, despite the fact that the stock has performed extremely well. But that's it. The U.S. uranium industry is in an interesting place. It's gone from being vilified to being subsidized. I felt cleaner about it when we were vilified, but again, as a shareholder, I don't mind those morons in Washington giving me free money. What I don't like about the U.S. uranium business is that by and large, it is nowhere near in the bottom quarter of the cost quartile or in the best quartile in terms of capital efficiency, even with the handouts, which is to say that it's a fairly marginal business with maybe the lowest cost of capital in mining.
Okay. Han is asking for an update on Emperor Metals. Are you upgrading your ranking? And what is the next answer question?
I'm not upgrading my ranking on Emperor. They're doing a fairly effective promotional job in a market that's desperate for promotion. My view of the whole range of those Abitibi juniors got upgraded at the Boca Raton conference. I've been a skeptic about companies that have deposits that might be subscale in the Abitibi because they've been subscale for the last 4 bull markets. I didn't want to go through, I don't want to go through another 10 years owning these names that can't get developed. Sitting down with Amar Al-Jundi, he said, you're looking at it with a view that's 10 years old and very out of date. You need to look at deposits that don't make sense as standalone 1 or 1.5 million ounce deposits, not in the context of those resources justifying a mill build, but rather you need to think about them in terms of the existing installed infrastructure that other people have. Building a mine without having to build a mill or processing facility and trucking the rock 10 kilometers or 15 kilometers mean that the satellite deposits that hitherto have had no value whatsoever because they couldn't stand the capital cost of building the processing facility can have substantial value to somebody that has existing value. And I'm looking at Emperor with that in mind, looking at Landor with that in mind too, deposits that I have viewed as stranded deposits that may not be stranded at all.
Rick, that's one of those insights that seems very obvious once someone like Amar has explained it to you.
It's interesting that after 40 years, it took somebody like Amar to explain that to me. One would have thought that all of the times I've been bitten by mosquitoes in the Abitibi, that more knowledge would have stuck to me. But mercifully, I'm a reasonably good listener.
Yeah, that's a good one. Okay, David wants to know if you have any thoughts on Belleview Gold.
None really worth sharing. I think the news out of Bellevue is fairly self-evident. The stock got hammered for a while when they disappointed investors. Now that the disappointment's fading, not surprisingly, the stock's doing better.
Okay. Question from Jay. Your views on Saturn Metals and Bravo.
Oh boy, Bravo I really like. I like the size of the deposit. I've come to really like Luis Alvarez, who I didn't know till Nikki Adshed introduced us. I like the platinum and palladium business. I like the fact that this platinum and palladium deposit is not in South Africa or Russia. And although it's too early to really like it, I like the idea that there is possibly a different deposit style on the same property, an iron oxide copper gold overprint. The geological environment is favorable for one of those. Some of the drilling data that we've gotten suggests that not only is one present, but that it has absolute grade. This looks to me like free upside. It may be true, it may not be true, and it kind of doesn't matter given the way that the underlying platinum and palladium values are working. So I really like it. Saturn, not big enough to be profound for me, but I own it. I own it because I understand why it's relatively cheap. It's relatively cheap because it's an open pit heap leach in Australia, which is not a style of mineralization that finds favor on the Australian market. It's an asset where the capital market is out of sorts with the asset. I also like it because there's adult supervision there. Jonathan Goodman from Dundee is a large and supportive shareholder, but he's also adult supervision. He, like me, is a retail shareholder. He wasn't a founder of the company. He's a guy who put in his money after the fact, and he's watching his money very carefully. So I do own Saturn, although I own nowhere near as much Saturn as I do Bravo.
Okay. Let's see. Martin is asking about Newmont. You mentioned that they've been cleaning up the balance sheet. Could they potentially become part of Rick's best of the best one day?
I think they could become one of the best. I think they're a long way from it now. There's some hard work they have to do now. They sold off most of their tier 2 assets. By the way, they budgeted receiving 2.2 billion. They received 4.7 billion and counting, which is a nice treat. The balance sheet went from being interesting to being pristine. More importantly, they freed themselves from having to make sustaining capital investments on deposits that didn't really matter to them. And they also don't have to devote sufficient management time and attention to those projects. They can focus on material projects. That's fantastic. Now they got to do a really hard thing. They got to reduce redundant G&A, which is a heartless way of saying they got to fire a bunch of folks. The way that you right size G&A around the fact that there's much less to administer, is you fire some folks. That's what has to happen. I mean, my dream trade, Albert, would be if Newmont and Barrick merged, and you repeated the process that you've done at Newmont, at Barrick. Barrick just sold off Tongan. They sold off Hemlo, which is a good thing. If you merged Newmont and Barrick, focused just on the tier 1 deposits, but particularly in northern Nevada, I suspect that you could cut G&A in half again, which would be a wonderful thing. It's interesting to note that both of those companies have had turnover at the CEO spot, which suggests that some of the personality pressure around merging might have gone away. This is speculation, by the way. I'm not talking based on any sort of inside information or scuttlebutt. But since we've come as far along as we have in the mergers and acquisition side, it would be lovely to see that one take place.
Yeah, and the I guess the reorganization of talent would be a benefit to some other company that would pick up this talent, right?
You know, you make a wonderful point. When Barrick took over Placer and thanked and excused all the exploration talent at Placer, that was one of the best things that ever happened to mining in Vancouver. You had all of these people who were buried in the bowels of Placer, and they were great explorationists. The problem at Placer was at the top. And you had all those people who you turned loose into Vancouver, and they generated billions and billions of dollars of value. If you took some of the people inside Barrick and Newmont who can't make a difference in Barrick and Newmont, they could make a real difference elsewhere. Some of these companies get very slow. I knew the former CEO of Newmont. I'm sorry, he wasn't CEO, he was head of exploration, Mike Thompson. I knew him pretty well. And he came up to me once at a conference, maybe it was mine, and said, you know, Rick, we're finally ready to start moving at Newmont. We're really ready to start wheeling and dealing. If there's any transactions that you can think about in the junior space where we can do joint ventures or do something like that that would be benefit to us or the juniors, please let us know. And I knew that they had a large Ontario database that they weren't doing anything with. I said, wait, right here. I got a really good Ontario geologist. I brought him there and said, okay, here, you guys got a database that you aren't doing anything with. You could do a joint venture with this guy where you had right of first refusal. And I remember Mike saying, now that's fast. I remember going back to Newmont and saying, because I read their will not go list, all the countries that they wouldn't do business in. And I said, I'd like to buy your databases from all of the countries that you have said you won't go into. Obviously, your avoided cost selling me these databases is nothing because you're never going to go back. And they wouldn't do it.
Yeah. That's very interesting. I could totally see that happening, though. These people would not just sit on their hands. They would get active. Okay, Antia asks, Rick, would like to know if the steep decline of the Rackla Metals share price after the announcement of the drill results is justified.
Well, I think the share price that it reached was unjustified. For people who don't know, Rackla is on the Northwest Territories side of the Snowline discovery. The Snowline discovery went from, a drill hole to a billion two. This is in the same belt of rocks, but even more remote. Before the deposit was ever drilled, it attained the market cap that one might have expected with a success, an area play. They released, I think, 3 holes, not great holes, and the market cap probably fell by 80%. I suspect that one needs to look at the rise before one looks at the fall and say, was that company trading at a market cap that was realistic relative to the data at hand? Ironically, I blame our conference for some of that. Rackla attracted a lot of attention at the Boca Raton conference, and it attracted that confidence in a market where the holders of Rackla were very close to the company, long-term supporters of Simon Ridgway. So you had a circumstance where there were more buyers than sellers. When the stock started going up, people were looking for the reasons that the stock went up, and they looked right next door at the meteoric success of Snowline, and they extrapolated, I think, that success and the share price escalation at Rackla in one of those situations where the market momentum justifies the narrative and they feed on themselves. All of which by saying, who was it, Nietzsche that said, that which is about to fall might deserve to be pushed?
Yeah, that's a good one. Okay, Sam is asking about, again, about Meteoric. We've already touched on management a little bit, but he also asked when a raise might be expected.
They're going to need more money. I mean, I think their last raise was 30 Oz. They are spending money, so I would suspect that what you see at Meteoric lasts 6 months before they start to get nervous. I'm speculating. It would be useful to ask Meteoric that same question.
Yeah. Okay. Rick, you talked about Andrew Tunks a little bit, the history with Paladin. So we know his credentials. One of the things he mentioned, though, was, they went out and got specific technical expertise for this specific situation. Can you speak to the qualifications of the people they brought in?
No, I can't, because I don't have enough knowledge around rare earths myself. I mean, I wish I could, Albert, and I'm trying very hard, witness the interview with Dave Wargo and others, to bring myself up to speed in rare earths. But at present, I can't speak to the talent of the second team because I don't have as much experience in rare earths as I would need to have to confidently answer that question.
Okay. From Martin, he's asking about, I don't know how to pronounce this, lunar spit out of NGX.
The royalty spin out of NGX is, I guess, what he's referring to. NGX has created a royalty on that deposit, and I think the market will treat it very well. The market likes royalties. I think the market is wise to like a royalty on a world-class deposit in the royalty company. The front-end capital cost shouldn't bother them because they won't bear any of it. The fact that this royalty comes out with the Lundin imprimatur can't hurt.
Are we seeing something that's going to be sort of permanent now, this affinity for royalties, Rick? They seem to be quite popular these days.
Yeah, you can still, well, you can raise money around anything now. So I think the creation of royalties will probably be less robust because companies that would otherwise have had to sell a royalty uh, to finance them on their corporate journeys will be more inclined to keep the royalty and issue shares to the public. um, I think you have a lot of critical mass and a lot of talent in the royalty space, though. And so I think I mean, in terms of the transaction that was announced by Lundin's, I think you'll see a lot of this. Uh, that royalty cash flow will sell at a substantial premium to the same cash flow to an operating company. And the idea that you can create a synthetic instrument and generate a larger combined market cap for your shareholders, pretty good piece of financial engineering. I think that continues.
You mentioned Centaurus earlier, Rick. David is asking, Centaurus is finally inching up. Anything new happening?
No, I think probably there were a couple of institutional sellers, people who got were worn out by the nickel trade. And I mean, it sounds trite, but I think we're back into a period where there's more buyers than sellers rather than more sellers than buyers. There hasn't been very much that's fundamentally changed with the company. I just think we wore out the sellers.
Okay. We periodically ask you about hedging strategies, Rick, and the answer is the same, but I think it's a good question. And I thought the answer you gave last time it was asked was the best answer I've heard so far from you. So Douglas asked, do you ever write covered calls or buy puts for short-term protection on your large cap companies?
I don't ever buy options. When I was in university, I learned that 98% of the options contracts ever written, if held to maturity, would expire worthless. I don't think I'm smart enough to go against odds like that. I love selling puts and calls when the VIX is above 20. Selling short dated puts and calls, what's called a bull spread, on stocks I like, where the VIX is high means what I'm really doing is selling the volatility. What's happened mostly for me over the course of my career is that the puts and calls expire and I get the premium and I keep the stock. What happens on occasion is the market forces me to buy low and sell high, and they pay me for it, which is not a bad thing. Psychologically, it can be hard because if a stock gets put to you, you're down on your whole position. You don't feel as good about that stock as you would if it was up. And when the stock gets called away from you, that's because the whole position is rocking. And sometimes you have, seller's remorse. But allowing the market to pay you to do what you would otherwise do rationally, which is to say buy low and sell high, if you've made good security selection on the underlying security, is a very good thing. We have a circumstance now where the VIX is at or above 20. And what that means is that in highly volatile sectors like gold and silver, you can monetize that volatility in the near term. Writing a 90-day bull spread, a put and call spread, or a 90 by 120 or something. And you may want to leg in, which is to say, on a day when gold is at or around lock limit up, when gold is doing very well, you might want to sell the call part of the put and call spread. And you might want to wait a week or 2 weeks when gold is softer or down to sell the put leg. But I like selling puts and calls on positions I like when the VIX is above 20. When the VIX is under 20, you can't sell volatility if there's no volatility.
Rick, I really enjoyed that answer. In my head, I didn't say it out loud, but you said you didn't like the odds of something like a 90+% failure rate. So instead, you went into mining finance.
Mining finance has worked for me
It absolutely has worked for you. But
I'm cynical enough to understand the failure rate and the causes of it. And I understand, I mean, my whole life is managing risk and reward. It's funny you mentioned that, Albert. I had a visit with our former mutual employee or employer, pardon me, Eric Sprott, and we were comparing our strategies. And I said, my real strategy in a business that has extraordinary returns when they work, but it's extraordinary risks, is that I try to manage my risks so that I can maximize our rewards. And he started laughing. I said, what was wrong with that answer? He says, I'm exactly the opposite. He says, I don't worry too much about my risks if my rewards are large. If you could ever merge Eric's talents with my own, which we tried to do to no avail at Sprott, you'd probably have one solid investor. But it's just a different perspective. From Eric's point of view, if he gets one Fosterville, where he made, I don't know, 100 times, 150 times on size. Eric didn't nibble in that position. He gobbled in that position. People look at him taking a $250,000 loss here or $300,000 loss there, forgetting that Eric's a billionaire, and a $300,000 loss, even one a week, doesn't change his decision to what to have for breakfast. But particularly if you juxtapose it against what was probably a $400 or $500 million win, you can understand the wisdom to what he does.
Yeah, absolutely. I remember him at the Sprott conference. I think it was 2015. He just flat out said that. I said, I don't worry about losing money.
That's what he told me.
Because I've made a lot. I don't worry about it.
When Sprott bought me, when they bought Global, we were trotted out in the sort of beauty contest in Toronto, and Eric saying all this nice stuff about, somebody who you would say when you just bought. And I remember there was a young analyst from RBC, and he says, so you've told us all the good things about Rick. What do you know that's not so good? What's bad? And I'll never forget, Eric laughed. He looks at me, and he said, the problem with Rick, he's been a lender too long. He's afraid to be right. When he has one of these ideas, if the idea has a preponderant chance of being right, he said, you got to storm those. You got to really, really, really storm them. You got to go big. And you can't be so focused on taking your bait back. You got to press these wins and cut your losses. So if I had a criticism of Rick, it's that he's often afraid to be right.
You've always called yourself a credit analyst by training.
Probably fair criticism. Probably fair criticism. And if you compare our net worths, I suspect that he's been more right about that than I.
Yeah, well, yeah, but in another life, Rick, if you believe in the multiverse, maybe there's an Eric Sprott who regrets some of that aggressiveness. You never know.
There's only one of those. There's only one.
Okay, just to stick with this question as we go out, Rick, you gave an answer last time someone asked this question, which I thought was a great answer. And you said you would rather put your time, because you haven't had much luck hedging, you would rather put your time into lowering the risk by doing more work on the investments themselves. And I think that was a great answer.
Yeah. And, there are people that have trading skills that are good hedgers. I'm just not one. When I've tried a lot of hedges in my life, Albert, because I take a lot of risk. I'm always looking towards risk mitigation. And let's just say that my hedging track record is not sterling. What I have been pretty good at over time is thinking through something and not making mistakes by thinking through it. So that goes to my strength.
Yeah.
People who are good traders, I think about John Hathaway as an example at Sprott. John Hathaway can hedge because he's more of a student of markets. I have found that I'm more a student of credit and companies than markets.
Rick, there's another factor, though, because if you look at this question, what comes out is, look, the names that you're buying, you can't buy options on, right? And buying an option on Franco-Nevada is not going to protect you from the biggest risk that you're taking, which is entrepreneurial.
Yeah.
Right?
That you bought the wrong name.
Yeah, I mean that's.
I know guys. I know guys who have a 30 company position in the juniors, and they'll short the junior index. And I guess that works. It's just I've never been able to make it really work for me.
It just doesn't hedge the biggest risk. It hedges kind of an ancillary risk.
That's exactly right. It hedges market risk, but it doesn't hedge investment risk or mistake risk.
Yeah. Okay. Rick, we are all out of time, unfortunately. So this session went by really quick. But before we go, I just want to remind people, Rule Classroom, we got the intro to rare earths. That seems to be in the spotlight now. So it's a great time to visit ruleclassroom.com. Take a look at the interview Rick did with Dave Wargo of SCP. Great interview. And then we just followed it up with this panel session with Meteoric Resources and Nomi Prinz. It was an excellent time. So please check that out. Rick, any last thoughts for the viewers?
None at all, except thank you for participating in the classroom. We have a great upcoming boot camp. I say great, we haven't put it together yet, but Northern BC will be a really, really, really interesting boot camp. I look forward to seeing you, Albert, and some of our viewers and listeners at the New Orleans Investment Conference. I would urge anybody who could attend to attend. In addition to the conference, if you really, really, really work at it, you can conspire to have some fun in New Orleans, which I intend to do.
Rick, someone asked me if you were doing your special session in New Orleans this year. Sometimes you've been known to do breakout sessions.
I can't remember if I'm doing a post-conference special or not.
I'll check with the schedule and
I sort of think I'm not. Right after the conference, Bonnie and I go to Switzerland to speak at Jessica Leventhal's conference. And then we take a bit of a vacation. We're going on a Nile cruise. And then after that, I go up to Mines and Money in London. So I rather suspect that my travel conflicts preclude those question and answer sessions, which I quite enjoy. But if I find out that I'm mistaken, we can inform the classroom, and anybody who's going to be in New Orleans should come to it. They're a lot of fun.
Yeah, it's a great conference. So noic.ruleclassroom.com. Rick, thanks. As always, this was a great session. I always enjoy these, and I know the people watching really appreciate you answering their questions. So thanks very much.
Well, I enjoy them as well, and thank you for both putting on this Q&A session and, in fact, masterminding the Rule Classroom.
All right.
Believe me, it wouldn't happen without you.
All right, Rick, I'll see you again soon. And to all you outside, take care.